What does the Fed's January decision mean for credit markets? Hi, I'm Chris Alwine. Today we're breaking down the first Fed meeting of 2026. What the Fed's decision to keep policy steady could mean for income strategies, and which inflation and labor indicators matter most as the data continues to send mixed messages. As expected, the January Fed meeting was uneventful. We expected the Fed to not change rates and to enter a period of a pause that could last a few meetings. There's reasons for this. The Fed had cut rates 3 times last year. And think of those cuts as precautionary cuts. The labor market was a bit weaker at that time. There was uncertainty about the impact of tariffs. So the Fed cut rates to the upper end of neutral. We believe neutral is between 3 and 3.5%. So the Fed funds rate around 3.6% does feel appropriate to us, and it also feels appropriate to the Fed. From the statement that came out at the Fed meeting, they upgraded the economic outlook. Before, there was a focus on a weaker labor market, possibly a weaker economy. Well, that language has been strengthened to a solid economic growth and a stabilized labor market. So certainly a bit more positive around how the Fed views the economy. The big question is the core inflation rate. So core PCE is what the Fed looks at. Right now, it's running about 3%. If we strip out the tariff impacts, it's lower than that, but it's still higher than what the Fed's target rate of 2% is. So when we think about that, setting a policy rate at or a little bit above the neutral rate would make sense, and that's what the Fed believes. Now, what it means for the Fed is data dependency. So the Fed is very much focused on the path of data, and the implications for investors is that we need to be as well. There's really 3 data points that we're focused on. The first is the level of economic growth. The second is the labor market, and the third is productivity. If we look at 2025 growth, it's been quite elevated, close to 4% over the trailing 3 quarters, driven primarily by productivity growth. Now, our economics team views growth around 2.1% in 2026, but with upside risk to that forecast. The second is the labor market. Now, we're in a low hire, low fire labor market. The labor force is relatively stable. Companies have the right number of workers. They're not letting workers go. They're not looking to hire workers. So in that environment, we should expect a world where employment growth is relatively muted, but with a stable unemployment rate. Now, that's a world where policy is calibrated about right when it comes to the Fed. Now, there's certainly risks to that forecast, and they come in 2 areas. If the economy grows faster, inflation stays at these levels, then we see a Fed on hold for an extended period of time. We don't see the Fed moving to a tightening position in 2026, but it would be likely result in the 1 to 1.5 cuts that are priced into the market today being removed. If productivity or the economic growth rate slows down, labor market stays low hire, low fire, and inflation begins to creep down some, that would give the room for the Fed to cut maybe 1 to 2 times, which is already priced in the market. So advisors have to understand that a lot of that view is priced in and where the divergent paths could take place when they think about how they want to build their portfolios. With the Fed on hold, it certainly has implications for how advisors should build portfolios. When we think about the 2 primary drivers of the performance of a fixed income portfolio, the first is duration. So that's going to be keyed off of the 10-year Treasury. 10-year Treasuries yield about 4.25%. We see that range about 3.75% to 4.5%. So the market is expected to be range bound, and certainly there's risks to break out to either side that have to be monitored. So the approach to that strategy would be to be tactical. So on the higher end of the range, look to lengthen duration, and on the lower end of the range of the yield range, look to shorten duration. The other is on the credit side. So we're in a world where credit spreads are at 25-year tights. So on the surface, they don't look that attractive, but we believe that they're justifiably tight. And there's a few drivers for that. The first is we see recession risk as remote in 2026 because the private sector is healthy. Households and the consumer are healthy. Certainly there's small pockets of weakness, but by and large they're healthy, as well as the corporate sector. Pockets of weakness, but by and large, the profitability, the leverage, the liquidity of corporate issuers is quite strong. We combine that with overall yield levels. Corporate spreads to treasuries are tight, but treasury yields are elevated compared to the past 25 years. So advisors are able to pick up close to 5% in a corporate bond for a 10-year security. And we think that's attractive. So the yield buyers like corporate bonds or spread sectors because of the overall yield, even with the tighter spreads. And so our approach to 2026 is we want to keep the yield up or the carry of our portfolios above the benchmark. We believe that we're going to see treasury rates outperform the cash rate, as well as credit sectors outperform treasuries. Sectors that we like financials, banks in particular. We like structured products, and we like selective high yield and emerging market sectors. So when we put that into the portfolio, we believe we can build portfolios that out-yield the benchmarks, that is carrier yield that we're going to be able to earn over the year. But for 2026, we expect to see a year where carry wins out and that we are range bound, but we certainly have to be mindful of either the upside and the downside tail risks that are always present. Be sure to like this video and subscribe to this channel to hear from Vanguard's thought leaders.